Okay, Alana, if I can turn over to you for a discussion of key performance indicators.
Thanks, Rich. So the purpose of this portion of today's meeting is to discuss the feedback received on the invitation to comment, financial key performance indicators for business entities, which was issued for public comment on November 14th, 2024. Comments on that document were due April 30th, 2025. The board received 37 comment letters. All comment letters were reviewed by the staff and are summarized in the board meeting handout. In summarizing and reviewing the comment letters, the staff identified the following key takeaways. Respondents provide mixed feedback on a potential project on financial KPIs. Many respondents indicated that a project should not be a high priority of the FASB for various reasons. These reasons include, 1, the relationship between the potential project and recently completed and ongoing FASB projects, including the disaggregation of income statement expenses and statement of cash flow projects. 2, the interaction with relevant existing SEC guidance. And 3, the expected cost of change. Comment letter respondents also provided feedback on the potential approaches to standard setting included in the ITC. Approach 1 in the ITC discusses standardizing commonly used financial KPIs. Some respondents noted that standardized KPIs could improve the transparency, comparability, and quality of reported KPIs. Some respondents noted that standardized KPIs may not provide relevant and useful information across different companies and industries. Approach 2 in the ITC discusses management-defined financial KPIs. Many respondents noted concerns about the operability, auditability, and potential costs to Approach 2. Respondents specifically noted the importance of coordination with the SEC if the board were to pursue Approach 2. In addition to the comment letter feedback, the staff performed supplemental outreach, including with investors, academics, and advisory groups. During this supplemental outreach, investors also shared mixed feedback on a potential project on financial KPIs. Many investors noted that a potential project should be a priority for the FASB, but there was diversity on the objective and potential solutions. Some investors supported the potential standardization of a few commonly used KPIs consistent with Approach 1 in the ITC. Other investors noted that management is best positioned to communicate their entity-specific results via KPIs. Some investors supported an approach that would result in more disaggregated information within the income statement and the statement of cash flows, and communicated that this approach would help them create their own KPIs for their analyses. I will now turn it over to the board to discuss questions 1 and 2 in the handout.
All right, so maybe same thing as we did on intangibles. We'll give it a shot on financial KPIs. Okay, so questions 1 and 2. Christine?
So again, I think this was also very helpful to see all the feedback that we got from stakeholders, and I think it really helped me to get my head around what the real problem is for investors, and it comes back to comparability. I believe that improved comparability in EBIT and free cash flow, which are two metrics that seem to be quite popular, would start with improved comparability in the inputs to those measures as they're presented on the financial statements. In the case of EBIT, presenting interest expense and tax expense on the face of the income statement according to a common definition for interest expense and tax expense would go a long way to helping to improve comparability in EBIT and in EBITDA. Similarly, on the cash flow statement, I think that we could do a lot to improve the comparability of the free cash flow metric if we cleaned up the cash flow statement to ensure that all items that impact net income are presented either as operating and investing activities, and all items that don't impact net income are presented as financing activity. So let me just give you a couple of examples. Under that simple way of thinking about the top half and the bottom half of the cash flow statement, that would result in all lease payments being classified as operating activities, regardless of whether the leases are classified as operating leases or financial leases. And that would result in a free cash flow number that no longer depends on how the company ends up classifying its leases. Another example would be presenting the impact of stock-based compensation as a financing activity, because that would ensure that free cash flow doesn't vary depending on how an entity chooses to finance the cost of the goods and services that it consumes in generating income. So that's not really approach one, but I do think that those improvements to the financial statements themselves could address the underlying concern that investors have about comparability issues with some of the KPIs that they rely upon. I'm definitely not a fan of approach two. And this feedback, what I'm going to say is consistent with what I took away from a lot of the feedback that we heard, which was that approach two is not going to result in any new information being presented to investors, because all it would do is take the numbers that are presented elsewhere and pull them into the financial statements. And those measures are going to be really stale by the time they get put into the financial statements. I don't see how repeating a number in the financial statements long after it was issued to the market is going to be at all helpful to investors. It seems that the only benefit would be subjecting those measures to audit, but I don't even understand how that would add any benefit, because there's no standard to audit to. I mean, by definition, non-GAAP numbers are non-GAAP. There aren't any standards to audit to. As a result, I don't know what an auditor would add other than to tick and tie the number that is presented in the financial statement to the source document, which might be the press release or wherever it was originally presented outside of the financial statements. I don't see that would really add much benefit. I don't see how an auditor would push back against a company to say, well, we don't like the way you measured your KPI and you need to do something else. I mean, on what basis? I don't know. They would be able to influence that. Excuse me, but most importantly, approach two does nothing to address the key problem, which is comparability. And that's another big strike against approach two in my mind. And then last but not least, that single benefit of audit would apply only in the case of the annual report. So you wouldn't even get that benefit in the quarterly report, which might somewhat address the timeliness issue, but then you don't get the benefit of the audit.
Okay, thanks, Christine. Fred?
Sure. It was interesting to hear the input and greatly appreciated it. I would say just generally, just a couple comments. One is that I think, as Christine talked about, I think there's little support for approach two, and I think we should move on from that. In terms of approach one, I think the thing that does resonate is a common starting point. I think that was raised by a number of investors. And so where could that be helpful? When I think about free cash flow, which is one of the major ones we looked at, I'm not sure a common starting point could be helpful there, because essentially investors today just take operating cash flows and subtract CapEx. So that's not a complicated thing that needs to be different. I do think potentially there's a statement of cash flow issue in terms of the inputs into that project, but I think that would be separate from a KPI project. In terms of EBITDA, I think that a common starting point, in my view, throughout this project could be helpful because right now footing kind of KPIs all the way back to net income when they have adjusted EBITDA kind of is a step that I think can confuse folks because those adjustments are, in my view, difficult to follow. But we did hear loud and clear from investors that, hey, these KPIs, including EBITDA, vary by industry. So one standardization, does that make any sense? So the one area I would kind of like to further explore is that industry differential really just on the E, or is it on the other inputs into EBITDA? Because if it's just on the E, then of course different industries are always going to make those changes. If it's on the other components to EBITDA, then maybe we don't have a project because everybody, different industries need different starting points. But so I'd like to just perhaps, and I know we talked a little bit about that in our small group meeting, but I would just like to explore that a little bit more to see if there might be a meaningful common starting point on that metric. Thanks.
All right. Thanks, Fred. Marcia?
So I agree that the feedback told us that we can eliminate approach 2 for a number of reasons. It's interesting. I always make the comment when we're talking about a project going on the technical agenda and I'm talking to a stakeholder group, I like to first start with here's the problem we're trying to fix. And I'm not sure the feedback, while I'm appreciative of the feedback we received, I'm not sure it gives me a compelling starting point at this point, even under the support for approach 1, as to what is the problem we're trying to fix, because there clearly was not unanimous support that these should be additional required disclosures. So if someone is saying I don't have to have this disclosure, then I'm struggling with the starting point to that question. That being said, I don't disagree. Again, it's a resource allocation and priority. If we have the resources and want to explore a little bit more to try and help us understand when we receive comments, what are they doing with this? But at this time, it's not so clear to me where there is support for this, because this to me is different than the first conversation we had about intangibles, where the first starting question is, that's already in GAAP. Should we do a major overhaul? Should we do a targeted improvement? And you could start with, well, there wasn't really clear support for a major overhaul, but there could be some targeted improvements, and you can sit down and identify taking the feedback and exploring where that could be helpful, useful, beneficial, and improve the disclosures that exist today. To me, this is a very different topic because it's much more at a conceptual base. And, I wonder, is this really something we need to address when we had a number of stakeholders telling us they don't think these are disclosures that need to be required?
Joyce?
Thanks, Rich. So first, I'd also like to thank the comment letter respondents and the investors who met directly with our investor liaison team and our research staff to provide feedback. In our investor outreach, of those who responded, a majority said yes, they support a potential project for KPIs. But investors expressed mixed views and various concerns about the potential benefits of the 2 approaches that are identified in the ITC, which indicates, in my view, that research beyond the 2 approaches outlined in the ITC should be considered. Standardizing KPI and GAAP definitions might only provide consistency in a GAAP-derived rules-based indicator, which would not necessarily be representative of management's view nor an investor's view of the financial performance or the cash flow prospects of an entity. A gap-defined KPI is likely going to be further adjusted, and therefore the intended comparability would not exist. Notwithstanding the potential for making improvements in the income statement and in the statement of cash flows, I would say that it could be argued that there are gap measures that are common starting points. They are net income, which companies adjust to derive an adjusted EBITDA, and there's cash from operating activities to derive an adjusted free cash flow. So what strikes me are the buy side and sell side investor comments that we received in our outreach stating that companies should define their management driven KPIs on their own, but have the entities disclose the inputs to derive the KPIs rather than create a standardized measure. So buy side and sell side investors who provided feedback to us expressed that they would like to see greater transparency about the components that create the non-GAAP measure. I think Fred even just mentioned that investors find the adjustments difficult to follow. They want to evaluate the nature of the adjustments that companies make to those GAAP reported measures and obtain an understanding of how and why the components of the adjusted EBITDA or the adjusted free cash flow measure are calculated and on which financial statement line item those adjusted amounts are reported. There were some comments regarding the SEC required non-GAAP reconciliation as being positively informative. Nevertheless, we also received some investor feedback from both buy-side and sell-side analysts mentioning the importance of the KPI being subjected to elevated independent controls and assurances to further enhance their reliability. And I take Christine's point earlier, albeit not all investors consistently expressed that sentiment, but we did hear from some who are interested in having that additional comfort around the information. So I think the ITC feedback raises questions and warrants further consideration. For example, could investors benefit from new disclosures placed within the notes addressing, for example, the financial statement amounts that management views are non-core, non-recurring, that are within the financial statements, addressing items within the financial statements that management identifies as distorting risk management activities, or other types of accounting results that companies may view are uneconomic under accounting requirements, all of which encompass adjustments that management makes in order to derive non-GAAP measures. So essentially requiring disclosure of the nature and the amount of those individual elements and the financial statement line items where those adjusted amounts are reflected, which comprise the financial KPIs, so that investors can get a better understanding as to how that GAAP common starting point, net income or free cash flow, results in those adjusted GAAP measures. We receive feedback from buy-side and sell-side investors who specifically stated that they want to evaluate the legitimacy of the management adjustment. And they want to be provided with more transparency over which line items or segments, which is another interesting avenue to take, where the adjustments relate to a specific segment. And that is beyond the information that investors currently receive in the current requirements. Another possibility is whether or not these investor concerns are more suitably directed towards the regulation of the non-GAAP reconciliation SEC rules to avoid confusion regarding a framework that is currently in place. So that is potentially a pathway as well. However, private companies would remain unaddressed. Or could investors, to Christine's point, benefit from a refreshed project that holistically addresses the financial statement presentation, such as for the statement of cash flows, as Christine mentioned earlier, addressing the appropriateness of the elements in the operating, investing, and financing activities, which enhancing the relevance and the decision usefulness of the presentation of the primary financial statements could be a broader pathway, and it may minimize some of the adjustments, but not necessarily eliminate the adjustments that investors make, nor would it provide transparency about the components of management's adjustments, which some investors requested in our outreach. Or there potentially is an approach to just wait and see what the impact of DICE and segment reporting and the current cash flow statement project will be in order for investors to perhaps get greater transparency around areas that they are not receiving today. So in my view, there are various pathways that could be considered. The KPI topic, I think, requires further research and analysis. It's clear in my mind that investors are interested in exploring this area. They believe that there are matters to address, whether it's transparency, comparability, or consistency. They are interested in all aspects. We can consider, I think, some of the pathways that I mentioned. But the solutions I believe that we need to explore are beyond the two approaches that are outlined in the ITC.
Hey, Sue. Thanks, Tristan.
So I'll try to be incremental, but again, I want to just thank the stakeholders who responded and actually thank them for those that started out their letter saying that this shouldn't be a priority project, but still continued to answer all the rest of the questions to say, but if you do choose to do something, here's a suggestion, because I think that's just as helpful considering the mixed feedback that we often get on these in the responses to these types of documents. And so, I think certainly there's a preponderance of feedback that suggests that this shouldn't be a priority project. And I think, Alana, you outlined a whole lot of reasons why. And it's interesting to me because when I think about KPIs, and I'm going to steal a phrase from your last discussion about it's not a one size fits all when you think about industries particularly. And so I'm not sure that we could ever get to a place in this type of a project where we could satisfy all investor needs, just given, how distanced you might ultimately get from what the KPI is that management would prefer versus what a standardized one would be. But having said that, I do think that, to Joyce's point about some of the, I'll call it the inputs to the KPIs, I think that our project on DICE and some of the other disclosure projects that we finished recently will provide information that could help with scope and path on how we might proceed with something like this. But that would also suggest that it's not a priority now. We know DICE G isn't effective until 2027, I think is the timing on that. I also think that the one thing that you mentioned, Marcia, was particularly wasn't clear what the problem was that we were trying to solve. So I sort of have share that sentiment. I do think, maybe just a nod to private companies. Certainly there were several letters that suggested that KPIs aren't nearly as pervasive in the private company reporting as they are in other places. And certainly access to management is another consideration. So if we think about something like that going forward, we might scope it accordingly, considering as well the SEC guidance for public companies. However, what I would be interested in is maybe looking at free cash flow as part of a statement of cash flow project, I think similar to how Fred articulated it. I think maybe there could be some utility there, and maybe sort of ring fencing it to that project would help us to be able to maybe finish something a little quicker.
Thanks so. Hillary?
Just a couple things to add, and I think, at least from my perspective, it seemed like approach 2 was a bit of a non-starter for many of our stakeholders, and I do agree with that. With regards to approach 1, I do think it was lukewarm feedback is the way that I would probably categorize it. And one of the things that I think was interesting to me that I didn't necessarily see highlighted as some of the comments, but has been a concern of mine, is if we were to standardize what are the components of EBITDA, the level of precision that would be required in order to do so, and some of the challenges that may bring up outside of this project. So for example, if I think of our DICE project a couple of years ago, right, we were requiring folks to break out depreciation and amortization out of relevant line items. There was a board meeting where there was a discussion of how do we determine what's depreciation or amortization? Do we say, just look at what you put under topic 360 and 350, or should the board go through each of the topics in the codification, look at anything that could be considered potentially depreciation or amortization, and have a list of those, effectively prescribing the treatment? And when we went through that, the staff did highlight, one, it was a pretty big exercise to go through, even for purposes of just a discussion with the board of what could be considered to be amortization or depreciation. And the staff identified many instances where the existing guidance is not prescriptive, right? So judgments would have to be made, and the board would have had to call balls and strikes, right, of whether something should be considered depreciation or amortization. And there was a concern, I think, that was expressed of what that would mean from potentially disrupting existing practice. And I find that keeps coming into my head when I think of this project, is what does that mean? We were just talking about depreciation and amortization, but we'd also have to do that for interest. We'd also have to do that for taxes, right? And I think there's certainly, and by no means do I think this is not potentially doable. We have a great staff, we have a great board, we could figure out these, categorizations. But I think from my perspective, that would be something I'd be interested in if there was overwhelming feedback that this was going to be really helpful from an investor perspective and that this was necessary from that standpoint. So I think that's really where I kind of question the whether or not the benefits would outweigh the costs in this situation, and whether the level of precision that we would need to do in order to break down each of those components is necessary for purposes of people providing a voluntary alternative performance measure. So that's probably, one of the overall, concerns that I would have with regards to this. I take Christine's point of, it sounds like she'd be more interested in, if we're going to be that prescriptive, doing it right for purposes of the income statement, right? For really being focused on what are the components thereof, not just for purposes of EBITDA. That's just one thing. And certainly I appreciate the diverse feedback here and all the different views that were expressed, but that's one that I didn't necessarily see kind of pulled out as part of the comment letters as much, that I just wanted to highlight. Nothing that couldn't be workable, but I think something that needs to be thoughtfully considered by the board for purposes of thinking about if we were to move forward on this project.
Thanks, Hillary. So I'll attempt to be incremental going last. Good news and bad news in this. So maybe some good news. We highlighted the two most frequent non-GAAP KPIs were adjusted EPS and adjusted net income. The good news was people didn't suggest we get rid of net income, and I think only a few suggested we got rid of EPS. And and so I look at those, and then I look at the EBITDA and free cash flow. I say, gee, what's different? Well, adjusted net income is pretty easy. You reconcile it to a GAAP definition. Adjusted EPS, again, you reconcile it to a GAAP required definition and presentation. EBITDA, under the SEC rules, if you think it's a liquidity measure, you reconcile it to operating cash flows. If you think it's a performance measure, you reconcile it to net income. which I certainly understand why people can't understand what's in that number, whether it's called EBITDA or adjusted EBITDA, because I think that reconciliation is starting from the wrong place. It's not starting from a GAAP-defined equivalent like adjusted net income and adjusted EPS is. And free cash flow, I was just happy to hear Fred found a use for the statement of cash flows, which he said free cash flow is easily derivable from the face, which is probably the first positive thing I've heard about it for a while. So what would I do? I don't think EBITDA is a good measure for everybody. I think there's pros and cons on it. Rightly or wrongly, though, 28% of the S&P 500, according to our stats, believes a form of EBITDA is an effective way of communicating their business. But we hear from investors, they don't necessarily always understand how that is defined. And when two entities in the same industry present it, they don't understand if it's comparable. The only way I know to deal with that is to come up with a common definition for those entities. So I would certainly be interested in there's requirements to furnish to the SEC certain financial data when you present it on a recurring basis. If an entity feels the most effective way to discuss their operating results is EBITDA or adjusted EBITDA, and they include it in recurring 8K filings, to me that seems to say that they find it very relevant, and rightly or wrongly, their investors are likely using that. I think there is a benefit for those entities having a standard EBITDA number in their financial statements. If for no other purpose than maybe one day the reconciliation will be to that number. I certainly recognize that we spend a lot of time defining amortization, depreciation. We have a definition of interest expense for capitalized interest. It's a pretty good definition. Income taxes, you can only put income taxes in the tax line. I think it's been very, it's restricted to that. You don't get to put your sales taxes in there. Is that the right starting definition? I don't know, but it's a consistent starting definition, and it's certainly one that we could explore. So I think that makes sense. As far as free cash flow, I do find it funny that's the one number you can compute, and so do you really need to do anything there? You know, I probably have more skepticism that we can do something with a cash flow statement that will drive users to it. But I'm always willing to learn. As far as the income statement, I think, you know, our DICE project went a long way to providing additional transparency about certain expenses. And so after I've left, you guys will get feedback on whether that was the case, but hopefully that will be. But, you know, my guess is whether the board at a future meeting decides to add a project on this or not, if we don't, this will not be the last you've heard of it. And it will often be in the context of relevance of GAAP. And it will be a continued question about if investors are continuously using these measures, does it make sense that the only place you can't find them is the financial statements? I might question, does that make sense? Probably not to me, but you know, ultimately we can decide that as a board. So with that, I think that gives our staff enough widely different directions to consider as we bring this back for our board to consider at a future meeting. But let me turn it over to Lana quick for an update on our EITF agenda.
Thank you. At its agenda committee meeting on Tuesday, September 9th, the EITF met to discuss one issue for potential inclusion of the EITF's agenda. The EITF voted to add a project to its agenda on mortgage servicing rights, and specifically whether or how the fair value measurement of a mortgage servicing right should include recapture. The EITF plans to discuss this issue at a future meeting. That's all.
That's it? All right. Thanks, Lana. With that wraps up today's board meeting. I do want to thank all of our stakeholders for providing us such great input, and we look forward to part 2 of these topics. So thanks, everyone.